Most traders draw trend lines correctly and still lose money on every single one. And that is the part nobody is talking about. The problem is not the drawing. The problem is the reading. Because there is a difference, a significant, account-destroying difference between placing a line on a chart and actually understanding what that line is telling you. Most traders never learn that difference. They keep drawing, they keep entering, they keep losing. And then they decide that trend lines do not work, when the truth is that they were never reading them correctly in the first place. Here is what those traders were never taught. A trend line is not an entry signal. A trend line is a question, and you do not trade the question, you trade the answer. By the end of this video, you are going to understand the 3 specific mistakes that cause 90% of traders to lose money on trend line setups. Exactly why professionals read the same line completely differently, and the precise protocol that changes a trend line from a guessing tool into a genuine edge. Before the mistakes, let me define what a trend line actually is in plain terms, because the definition matters more than most people realize. A trend line is a diagonal line drawn across a series of price highs or price lows that shows the direction and rate at which the market has been moving. In an uptrend, you draw it connecting the rising lows, the floors that the market keeps bouncing off as it climbs. In a downtrend, you draw it connecting the falling highs, the ceilings price keeps bouncing off as it falls. That is the mechanical definition. Here is the deeper one. A trend line is a record of where buyers or sellers have repeatedly shown up before. It is not a magic level. It is not a line the market is programmed to respect. It is a behavioral map, a visual record of the prices at which, in the past, one side of the market consistently overpowered the other. That is all it is. A trend line does not hold because of mathematics. It holds, when it holds, because enough market participants are watching the same level and making the same decision when price arrives there. The moment you understand that a trend line is a behavioral boundary, not a mechanical one, everything about how you read it changes. An amateur enters a trade because price touched a trend line. A professional enters a trade because price reacted to a trend line in a specific, readable way. That distinction is the entire video. Everything else is the proof. Let me tell you about Priya. Priya had been trading for 2 years when I encountered her situation. She understood technical analysis. She knew what a trend line was. She could draw them. She drew them every single session, on stocks, on currency pairs, on futures. Her problem was that she entered every trade the moment price touched her trend line, because that was what she had been taught. Touch the line, enter the trade. What she did not track, because she had never been told to, was how often the line held versus how often it broke through and stopped her out. When Priya finally went back through 4 months of her entries and recorded the outcome of every trend line touch she traded, the number that appeared on her screen stopped her cold. 51% of her trend line touches had immediately broken through her stop. She was not losing because her lines were badly drawn. She was losing because the touch itself is the moment of maximum uncertainty, and she was entering exactly there, every time, without waiting to see what the market decided to do. Over those 4 months, that habit had cost her $4,200 across trades that were individually sized at what felt like a reasonable 1.5% account risk. Priya did not need a new indicator. She did not need a new market. She needed to stop entering at the touch and start reading the reaction. Now let us go through the 3 mistakes. These are specific, behavioral, and fixable today. The first mistake is trading a trend line that has only been touched twice. 2 points create a line in geometry. In trading, 2 points create a hypothesis. A trend line touched twice tells you that price once respected a diagonal level. That is all. It does not tell you that the level has any consistent behavioral significance. The third touch is what separates a drawing from a structure. Think of it this way. If one person tells you a restaurant is excellent, it might be true. If 2 people tell you, you start to take notice. If 12 people tell you independently, you trust it. A trend line works by the same logic. The third touch is confirmation that the diagonal level is not accidental, that the market has a consistent behavioral pattern at that angle. Every trend line touched 3 or more times is showing you a repeating decision point. That is the only kind of trend line worth trading. The second mistake is entering at the touch instead of the reaction. This is the most expensive mistake in trendline trading, and it is the one almost nobody teaches you to stop making. When price arrives at your trend line, what is actually happening in that moment? Nothing is decided yet. Price has arrived at a level where buying or selling pressure previously appeared, but it has not yet shown you whether that pressure exists today, at this price, in this market condition. The touch is the market asking a question. Will buyers show up here again? Will sellers defend this ceiling one more time? You do not know. The touch tells you nothing about the answer. The answer appears in the candle that forms after the touch, the reaction candle. A strong rejection wick, where price pushed into the trend line and was immediately repelled, leaving a long shadow and closing back away from the level. A bullish or bearish engulfing candle, one that swallows the previous candle entirely and closes convincingly away from the line. A pin bar, a candle with a tiny body and a long tail, showing that one side tried to push through and failed decisively. These reaction formations are not decoration. They are the market confirming that the level still has behavioral significance. The reaction candle closes. That is your entry, not the touch, the close of the reaction candle. An amateur sees price approaching the trend line and feels urgency. A professional sees price approaching the trend line and goes completely still. An amateur redraws the trend line when price breaks through it. A professional asks whether the break was real or a trap before touching the chart at all. The third mistake is trading the break. When a trend line breaks, when price pushes through and closes on the other side, the majority of traders immediately enter in the direction of the break. They sell the break of an uptrend line. They buy the break of a downtrend line. And they are wrong, statistically, somewhere between 40 and 50% of the time. Trend line breaks are among the most common trap setups in all of technical analysis. Here is what actually happens in many of those breaks. Price pierces through the trend line, triggering a rush of break traders who enter and place their stops on the wrong side. The market absorbs that liquidity, reverses, pushes back through the trend line in the original direction, and runs the stops of every trader who chased the break. The professionals who read what happened were waiting for exactly this. They did not enter the break. They watched the break, noted it, and then watched for what happened next. If price broke an uptrend line and then returned to retest that line from below, with the line now acting as resistance, pushing price back down, that retest is confirmation. The structure has genuinely changed. That is the entry. If price broke the line and never came back to retest, the trade was not yours. Let it go. There will always be another setup. Here is what the math actually looks like when you apply these three corrections together. The average trader entering at raw trendline touches with 2-point lines gets a setup that holds roughly 45 to 50% of the time in the short term. Their reward to risk is often compressed because their entry is imprecise. They are entering at the touch, which means their stop has to sit far enough beyond the line to account for the noise. Now apply the 3-touch rule, the reaction candle entry, and the retest before break confirmation. The hold rate climbs towards 65 to 70% because you have eliminated the lowest probability subset of touches. More importantly, the precision of your entry improves dramatically. When you enter on the close of a reaction candle rather than the touch itself, your stop sits naturally below the rejection wick, a tighter, more logical invalidation point. A tighter stop means a smaller stop distance. A smaller stop distance, with the same 1% account risk, means a larger position size. And a larger position size with the same risk means the winners, when they come, produce meaningfully more dollars. The math rewards precision, and precision in trendline trading means waiting one candle longer than everyone else. Now let us talk about why that one extra candle feels nearly impossible to wait for, because if this were easy, everyone would already be doing it. Your brain is running a program right now that was written before you ever opened a chart. When price approaches a level your brain has marked as significant, and a trend line is a visible pre-drawn level, your prefrontal cortex, the rational planning center, begins preparing for action. Simultaneously, your dopamine system spikes in anticipation of the potential reward. The closer price gets to the line, the more your brain is firing. By the time price actually touches the line, you are in a neurological state that is pushing you to act, not asking you, pushing you. The impulse to enter at the touch is not impatience in a general sense. It is your dopamine system treating the potential entry as a reward in itself, independent of whether the setup has confirmed. The brain experienced in chasing trendline touches is not a brain that is making poor decisions. It is a brain that has been trained by repetition to release dopamine at the touch, regardless of what should happen next. The professional who waits for the reaction candle has done something far harder than learning a rule. They have retrained their reward response so that the dopamine fires not at the touch, but at the close of the confirmation candle. That retraining is not a reading technique. It is a behavioral transformation. Charts never lie. The lies come from your fear, your greed, and your impatience. Here is the protocol. 5 steps. Apply them every time, without exception. Step 1. Draw your trend line using a minimum of 3 touches and connect candle wicks, the extreme points of the candle, not candle bodies. The body shows where price opened and closed. The wick shows where price went and was rejected. Rejection points are the behavioral data you need. Bodies are the settlement price. Wicks are the decision. Step 2. Treat the trend line as a zone, not a precise line. Add a small buffer of 5 to 15 points, pips, or ticks on either side, depending on your instrument, because the market does not operate in single pixel precision. A zone acknowledges the reality of how markets move. A single line pretends precision that does not exist. Step 3. When price enters the zone, do not touch the entry button. Watch. Switch to a slightly lower time frame if needed to see the candle structure developing at the zone. You are looking for one thing only, a clear behavioral rejection. A wick that probed through the zone and was pushed back. A candle that closed convincingly away from the level with a visible body in the direction of the expected move. Step 4. The reaction candle closes. That is your entry signal. Place your entry order immediately. Your stop loss goes on the other side of the rejection wick, below the lowest point of the wick if you are buying, above the highest point of the wick if you are selling. This stop is precise because the setup is precise. If price goes back past that wick, the rejection was not real. The idea is wrong. You exit quickly with a small, pre-planned loss. Step 5. If price breaks through the trendline zone without a clear rejection, do not enter the break. Mark the broken trend line on your chart. Watch for price to return to that level and test it from the other side. A genuine break will be retested. The retest, if it holds and confirms the new roll of that level, is your entry. If no retest comes and price runs without you, acknowledge it calmly, mark it in your journal, and move on. The market does not owe you a perfect entry. It owes you nothing. Your job is to be there when the conditions are right, not to force your way in when they are not. 90% of traders read trend lines as entry signals. The remaining 10% read them as information. One group enters at the touch and wonders why the line keeps failing them. The other group waits for the reaction and understands that the line never failed. They were entering before the line had a chance to speak. The setup must prove itself before you commit capital. Write that down. Post it somewhere visible. Make it the first question you ask when price arrives at any level, on any chart, on any time frame. Has this level proven itself yet? Or am I about to enter the moment of maximum uncertainty and call it a trade? Reading proves itself. Patience proves itself. Precision creates the entry that did not need luck because it was never based on hope. The next video breaks down how professionals combine trendline reading with the volume signals we covered 2 videos ago, building a complete 2-factor confirmation framework that removes the largest single source of uncertainty from every entry you take. Subscribe now because that is the system that ties everything together. And if this video changed how you look at the lines already on your chart, drop trend line in the comments. Tell me which of the 3 mistakes has been costing you the most. I read every one. The trend line was never failing you. It was waiting for you to stop trading the question and start trading the answer.